Let me take you through some examples. Now we should do this together. I'm discussing about tax base of an asset first. Interest receivable has a carrying amount of 1200. The related interest will be taxed on cash basis. You have recorded interest receivable in your financial statement carrying amount of 1200. The tax authorities say that only when you receive it, they'll consider it as income. So what is the tax base according to them? What is the tax base according to them? They're considering it nil. They're saying that we'll only consider it as income or an interest received when you receive it. So according to them, there is no income as of today. But you know that there is an income of 1200, you will be receiving it in future. If you will be receiving it in future, will you be liable to pay tax on it? So carrying amount of interest receivable is what? Interest receivable. Carrying amount 1200. This is accounting books. According to textbooks, interest receivable is how much? The related interest will be taxed on cash basis, means only when you receive cash, they'll consider it as income. So as of today, it is 0. If carrying amount of an asset is higher than tax base of an asset, it will give rise to DTL. Carrying amount of an asset is higher than tax base of an asset, 0, DTL. Agree? The second case, a loan receivable has a carrying amount of 15,000. The repayment of loan has no tax consequences. Means what? No DTA or no DTL. It itself says. That means the accounting books will say 50,000. Tax base will also be 50,000 since there is no 15,000. Since there is no difference. Loan receivable 15,000 has no tax consequences, means textbooks also says that loan receivable is 15,000. Agreeing to it, matching it. No DTA, no DTL. When there are no tax consequences, means no DTA, no DTL. Third, trade receivables has a carrying amount of 2,500. The related revenue has already been included in computation of tax. Means what? Already been included, already taxed. You have recorded an income of 2,500. The tax authorities have also included it as income as of today. Will it result in any deferment of tax or already included? Trade receivable 2,500. They have also included 2,500. They did not wait for it to be received. They said that okay, we are including it as part of your income. Included as part of computation of tax. They are not deferring it. Not deferring it means no DTA, no DTL. Agree? You simply have to think through it. An item of plant and machinery with historical cost of 20,000 has deducted tax depreciation of 5,000 in textbooks. What is the tax base of an asset? Now this example is about the tax base of an asset. How much is the tax base of an asset? Historical cost 20,000 has deducted tax depreciation of 5,000. And I assume that accounting depreciation is same. Will result in no DTA detail, but if accounting depreciation was 10,000 or accounting depreciation was 4,000, I assume accounting depreciation is 4,000, tax depreciation is 5,000. How much is tax base of an asset? Give me the answer for tax base of an asset in the chat box. How much is the tax base of an asset? How much is tax base of an asset? $15,000 is the tax base of an asset. Now you got it. Is this clear now? For PP item, there is no information given on accounting depreciation. I assume it to be 4,000. So carrying amount according to accounting books is 16,000, but according to tax books it is 15,000. So tax depreciation is 5,000. Carrying amount of higher is higher than tax base on asset. It will give rise to DTL. Now let's come to tax base of a liability. Now have a look. Tax base of liability is amount attributed to that liability for tax purposes. The carrying amount of a liability less any amount which will be deductible for tax purposes. Now you need to tell me tax base of a liability. Borrowed loan has a carrying amount of 50,000. The repayment of loan has no tax consequences. How much is the tax base of liability? The tax base of liability will be same as accounting liability if there is no tax consequence. $50,000. Perfect. Accrued expenses with a carrying amount of 2,000, rent outstanding, the expense will be deducted on cash basis for tax purpose. What is the tax base of liability? What will be the tax base of liability? Rent expense is shown as rent outstanding at 2,000. Tax base of liability nil. Perfect. Rent outstanding, tax base of liability is nil. 2,000 less any amount available for deduction in future. Yes, 2,000 available for deduction in future. Nil. Carrying amount of liability is higher than tax base of liability, resulting in DTA. Carrying amount of liability is higher than tax base of liability. Carrying amount of liability is higher than tax base of liability, resulting in DTA. Accrued expenses with the carrying amount 2,500, the expense is already deducted for tax purposes. Means what? Not available for deduction in future means no tax consequences. So tax books will be tax base of this liability will be same. Perfect. Now you got it. Feeling successful. Interest expense. $2,500. interest expense 2500 already included, no amount available for deduction in future, no DTA or DTL, no difference. I'll show you examples wherein there is no DTA or DTL in these examples. These are the areas when carrying amount is equivalent to tax base. Accrued expenses which have already been deducted in determining an entity's current tax liability for the current or earlier periods, if they've already been included or deducted, means no chance of deduction in future. No chance of deduction in future means carrying amount is equal to tax base, no DTA DTL. A loan payable is measured at the amount originally received and is the same amount repayable on maturity. No amount available for deduction. The tax base of this liability will always be same, no DTA DTL. Accrued expenses which will never be deductible for tax purposes. Entertainment expense which we showed as an expense was charged tax today and there is no chance of reversal in future. This is a permanent difference. So tax base of liability is same. Accrued income which will never be taxable. If not taxed today, will never be taxed in future means permanent difference. We avail the benefit today, will have no chance. So deferred means if there is any chance of deduction in future, if there is any chance of being taxed in future, we record DTA or DTL. But if there is no such chance, it will result in no tax consequences, means no DTA, no DTL. Hope the deferred taxes are clear today. Though they were clear with you, but hope they have been more clearer or more strengthened today. One catch now. How to deal with deferred revenue? Deferred revenue of 60,000 in your books means you have received amount received in advance. The accounting has not shown it as part of revenue. But tax authorities, the moment they saw an amount coming in the entity, they charge tax on it. Will they be allowed relaxation in future? Will they be allowed relaxation in future when they show this? When they show it as part of revenue, when they actually earn it? Deferred revenue means money received in advance, but they've not recorded it as revenue. When they earn revenue, what is the entry? The entry turns out to be deferred revenue. Suppose they earned revenue of 15,000. Deferred revenue, debit 15,000, credit revenue 15,000. For the first time, they're showing it as part of accounting books. But tax has already been deducted on it, because the moment 60,000 came in, the authorities charged tax on it. Will they be allowed relaxation? Will they be charged tax on it in future? No, they'll not be charged any tax on it in future. So how this is dealt with? They've already paid higher tax, DTA. How this is dealt with? Revenue received in advance. Tax base will be slightly different. Carrying amount less any amount that will not be taxable in future periods. Because we have already taxed carrying amount less any amount that will not be taxable. So how much amount will not be taxable? The 60,000 will not be taxable in future. We've already been charged tax on 60,000. How much is carrying amount? 60,000. Tax base of this liability, carrying amount less any amount which will not be taxable in future. How much amount will not be taxable in future? 60,000. So tax base of this liability is nil. When carrying amount of a liability is higher than tax base of a liability, when carrying amount of a liability is higher than tax base of a liability, it will give rise to DTA. Since we have already paid higher tax today, this will result in DTA. But this tax base of liability is slightly different from the normal liability because this is deferred revenue liability. In deferred revenue liability, we have already been taxed, and now we need to see how much of it will still be provided relaxation. Will they be allowed relaxation in future when they show it as part of revenue when they actually earn it? Yes. They will be allowed for full 60,000 in future. It will not be taxed. Is this clear? The treatment of deferred revenue. In the tax base of liability, the treatment of deferred revenue is slightly different. That it is money received in advance, which is already taxed. Now we need to see how much of it will not be taxed in future. So we almost reached at the closure of taxes. Hope it is clear to everyone. So we have reached. Now you can formulate all the 4 formulas and you can also know what is DTA, what is DTL. Can I feel confident? Let me take you through the presentation now. Income taxes IS 12 is to be applied in accounting for all income taxes, domestic tax on profitable taxable profits, foreign taxes on taxable profits, or any withholding taxes payable on distributions. Accounting profit is the P&L profit which we calculate, and we calculate tax expense on it. Tax profit is the profit we calculate according to tax principles. Tax expense is the amount we include as part of our income statement. It is a combination of current tax as well as deferred tax. It consists of current tax as well as deferred tax. You know it now. So income tax is payable on the basis of tax computation is current tax. It is recognized as an expense in the period in which the profit is earned. As income in period in which loss incurred when loss carried back to recover tax paid in prior period, we can also carry forward losses in future, and they also help us in recognizing DTAs. Now, depending on which jurisdiction you are, you can carry forward losses up to 5 years or 3 years. The carry forward of losses also results in DTA because you have a chance to recover it against future taxable profits. If your tax principles allow you to carry forward your losses, when you earn income in future, you can set off these losses and can reduce your income in future, on which tax will be calculated. So losses also result in carry forward of losses also result in DTA. We'll apply the enacted tax rate, but if there is a change in the future tax rate, we can also apply the future tax rate for calculation of deferred taxes. You can decide to use the future tax rate because that future tax rate will be the amount on the basis of which you'll be settling your future liabilities. Deferred tax is the income tax payable in future periods on taxable temporary differences. Taxable temporary differences give rise to DTL. Deductible temporary differences give rise to DTA. So income tax is recoverable in future if you are able to recover the taxes you have paid today in advance, and you will be able to recover those taxes in future against any future income in the form of deductible temporary differences give rise to DTA, in the form of unused tax losses carried forward, in the form of tax credits which you have received. If you are able to claim not to pay tax in future, they results in DTA. Account for the taxes of future recovery of carrying amount of an asset. Future recovery of carrying amount of an asset means taxable temporary difference. You are using an asset, you are consuming an asset, you are charging depreciation, you are recovering in the form of charging depreciation. On what basis tax authorities allow you, whether accelerated depreciation or whether reduced depreciation? If they allow you accelerated depreciation, it will result in DTL. If they allow you reduced depreciation in initial years and continue to give it for a period of 8 years in our example, it will result in DTA. Future settlement, you're settling a loan, you're settling an interest outstanding, you're settling a rent outstanding. Does it result in a deduction in future? If it allows settlement, if there is any tax consequence because of it, no tax consequences means no DTA DTL. If there is a tax consequences because of it, it will result in a DTA or DTL, settlement of liabilities. Compare the carrying amount with the amount attributed to asset or liability for tax purpose. Since IS 12 talks about only balance sheet approach, is the reason it is talking about what is the carrying amount of an asset compared with tax base of an asset, carrying amount of liability, compare it with tax base of liability, we'll get the difference, apply the percentage on it, we'll get DTA or DTL balance. Measure deferred tax assets liabilities using the tax rates and tax laws that apply to the expected manner of recovery. How we plan to recover it? We plan to recover it by 20,000 every year in accounting books, but tax authorities are allowing us to recover 50,000 in year 1, 50,000 in year 2. That will result in a difference, resulting in a tax consequence. We record it as DTA or DTL. Enacted tax rates applicable, so we will apply the tax rate. Suppose 30% is the tax rate, you apply 30% on the difference and record DTA or DTL. Tax base of an asset is the amount attributed to that asset for tax purpose. In our example, if you notice, the tax base of an asset on day 1 was 100,000. Tax base carrying amount was 100,000, tax base was 100,000. But after 1 year, the scenario changed. The carrying amount of an asset was 80,000, but tax base of the same asset was 87,500. There is a difference which will be recorded. Amount which will be deductible for tax purposes when any taxable benefits flow to the enterprise. 100,000 will be deductible for tax purposes when income flow to it. After year 1, 87,500 will flow to the entity and it is available for deduction. 75,000 will flow to the entity, it is available for deduction. How much of it is available? 87,500 is available. According to us, carrying amount is 80. Tax base of this asset is 87,500. So we record what will be available for deduction. That is the tax base of an asset. We have already done these examples. I hope I don't need to go through them again. Tax base of liability, carrying amount less any amount available for deduction when you settle this liability. We have already done these examples. All the scenarios when carrying amount is equal to tax base resulting in no tax consequences are clear with everyone. Deferred revenue we have dealt with. Taxable temporary differences give rise to DTL. Differences between carrying amount in the balance sheet and tax base is known as taxable temporary differences, will result in taxable amounts when the asset is recovered or liability is settled, will result in tax consequence in future. If it results in tax consequences in future means DTL. Again repeat, taxable temporary difference, not taxed today, will be taxed in future. If it will be taxed in future, it results in DTL. Deductible temporary difference, not allowed deduction today, but will be allowed deduction in future. If it was not allowed deduction today means tax today. And if it is taxed today and will be allowed deduction in future means we'll get relaxation in future. If we'll get relaxation in future, we should record a DTA today, deferred tax asset today, for not allowed deduction today, but will be allowed deduction in future, resulting in deductible temporary difference. Deductible temporary differences give rise to DTA, deferred tax assets. Or when liability is, when asset is recovered or when liability is settled, they give rise to deductible temporary differences. This is summary which we summarized. Now look at the asset. Carrying amount of an asset is higher than tax base of an asset, DTL. When you know this formula, you can formulate the other two. Carrying amount of an asset is lower than tax base, DTA. For liability, opposite of what happened for asset. Carrying amount of a liability is greater than tax base of liability, opposite of what happened for asset, DTA. Carrying amount of a liability is less than tax base of liability, opposite of what happened with asset, DTL. Can you formulate all the four formulas? Can you formulate the formulas? If yes, the job is done. The possible temporary differences can be in the terms of depreciation, accelerated depreciation, revaluation model. Income tax authorities do not believe in revaluation model. They still believe in cost basis. Provisions you may have created, they may not believe it because until you pay them, they do not agree to it. Present value, you're using discounting in your accounting, but the concept of discounting is not yet acceptable by tax authorities as of today. Pensions are on and revenue are on accrual basis, but they only believe it in cash basis. Interest you may have recorded on accrual basis, they only believe it on receipts basis. So these result in temporary differences, resulting in DD or DTL. So the rate will be the rate applicable by law. If there's any change in the future rate, you can use the future rate for calculating your deferred taxes. So companies are required to disclose the amount of deferred taxation in the tax expense that relates to change in tax rates. If there's any change, they need to compute the deferred taxes on the basis of the change rate, because that will be their liability or recoverability of asset in future. So tax assets and tax liabilities should be presented separately from other assets and liabilities in the statement of financial position. Therefore, tax and liabilities should be distinguished from current assets and liabilities. They are non-current asset items. They are presented separately because they are going to be settled beyond 1 year. So an entity should offset current assets and current tax liabilities. They can present one line item. Current assets and current liabilities, they can present in one line item. If they have a legally enforceable right to set off in their jurisdiction or in their country, if they're allowed to do so, they can do so. If they're not allowed in their jurisdiction, they should not. IFRS allows offsetting if it allows. Intends either to settle on net basis or to realize the asset and settle the liability simultaneously. Since it is with the same authority, we use as a single line net basis, therefore tax asset to therefore tax liability in the balance sheet. We don't present two line items, DTA or DTL separately. We present whichever is higher. If DTL is higher, we'll present DTL. If DTA is higher, we'll present DTA. Because it is with the same authority. The settlement is with the same authority. Entity should offset therefore tax assets and liabilities for the same reasons for which we are allowed to offset current assets and current liabilities if the entity has legally enforceable right to do so, and if deferred tax assets and deferred tax liabilities relate to income taxes levied by the taxation authority on either the same taxable entity or different taxable authorities or different taxable entities which intend either to settle current tax liabilities and assets on net basis or to realize the assets and settle the liabilities simultaneously in each future period in which significant amounts of deferred tax liabilities assets are expected to be settled or recovered. So if it is allowed according to the tax authorities or accounting principles, we can do so. Tax expense related to P&L from ordinary activities should be presented in the statement of comprehensive income statement. Any tax related to OCI should be presented as part of OCI. This is all for IAS 12 income taxes. Hope you have understood it. If you have any questions, please ask. I'm happy to repeat if anything required.